Hello traders, Gary Wagner here just before 11 o'clock in Honolulu, 5 o'clock in New York on Friday. Happy Aloha Friday as we say on the islands. It is the 23rd day of May 2014 and this is the daily report for gold and silver, our weekend review. And what a tepid week we've had at best, slightly lower on the week, currently trading in essence down $1 to $2, call it $1.60. As you can see, current print on the screen, $12.91.93, call it $12.92. That, of course, is your bid. Your ask is going to be $1 above that at $12.93. The low $85.80 and the high $96.40. Silver also trading quietly lower, 1943. That's our current screen print. The low 1922, the high 1961. More on silver towards the end of the show. Really, to amplify the kind of quiet week we've had, I'm going to start today's show by looking at a weekly chart, standard candlestick format, which in essence means that you're looking at true opens and true closes. So that when we're looking at a green candle, of course, it opens at the low and it closes higher or above. That's what makes it green. It opens and then closes lower. That's what makes it red. Now, if we take a look at the last 2 weeks, now we've had this compressed trading range. We'll talk about that throughout the show. But if we look at these last 2 weeks, you have, in essence, a true doji occurring here in the candlestick that's formed on a weekly basis. Your open and close are almost identical. When I say slightly lower, we're lower by a couple of ticks, but in essence, you've got a doji. But when we consider the amount of small-bodied candles that we've had over the last, say, 6 weeks, 1, 2, let's not call that a small-bodied candle, 3, 4, so we've had over the last 5 or 6 weeks, roughly 2/3 of them have been very quiet in terms of the comparison from the open to the close, which of course is what's given us a compressed market or a compressed trading range. One of the best ways to look at this compressed trading range is a shorter term chart. We're looking at a 240-minute chart. Let's go ahead and let me compress that a little bit so you can see where we're deriving our different lines from. I have our upper resistance line, of course, and that's simply based upon these tops. I have 2 lines on the bottom. They're both coming in from this low. This is going through the real bodies and then extending that forward. This is going through the real lows and extending it forward, as you can see, to account for these lows, because we had the market genuinely come into this range, but if we draw our compression triangle from these lows, you'll find that it hasn't dropped out of that range. If anything, it stayed right within that range, and so that's where this particular set of trend lines are being drawn from. So what I've done is I've gone in and greatly enlarged the most recent activity on this chart. Realize it's only a 240-minute chart, so when we consider this is the beginning of May right in here, beginning of May really showed us really the highs that we've had. And what we're noticing about the market, and this is what has been of interest to us as we looked at this on our daily show, is the fact that this market continues to compress in terms of range. And the easiest way to define a market that's really compressing in terms of range, let's go ahead and uncompress this just a little bit. And here's what we're saying. When we take a look, first of all, at the top of this market, we've got this high. This is that high at about 1330, 1328 is where I've got it pegged. The next top that we get is absolutely a lower top at around 1312. Then we get this top right in here. That's, I believe, at around 1308 or so. And then these last 2 tops are, I know this one's 1305. It looks this is equal. So when we consider the series of highs, here to here is a lower high, lower high, lower high. Now let's look at the lows. When we look at the lows, we've got this low. This low is absolutely tracking just at around, I believe it was 71, but now maybe even 68, excuse me. So you've got this low here, then you have this low, and this could have been 72. This is a higher low yet again here, and then a higher low here again here. So we've had these series of lower highs, we've had a series of higher lows, and that spells compression. In other words, the range continues to narrow. Now, I did send out a special trade alert. We had our stop very, very loose, meaning about 0.5% below 83, and I've recommended that we put it just below, meaning about $3 to $5 below that. The reason is, over the weekend, we've got a lot going on in Ukraine. And if, in fact, there is some sort of peaceful resolvement of the issue, when I say peaceful, meaning not a resolvement, but the perception that it's getting better and it's de-escalating rather than escalating, we could see the premium, that safe haven premium that's been in gold, quickly erode. On the other hand, if there is some sort of escalation in what's going on there, we could see this really spike up. We're getting close to the apex. We're probably going to get some sort of breakout, but I can tell you this, one of the titles of our market forecast this week was, is this the quiet before the storm or the quiet before the quiet? And what I meant by that is, I have never seen gold in the last 4 years track like this, where it really defined such a narrow range over such a prolonged period of time. We haven't seen that happen. We talked about it bunching up and then spiking up, and that was on the way up. But we haven't seen this kind of activity for the longest time that I can remember, in which the market stagnated and sat in such a defined range for such an elongated period of time. Because of that, and because of the fact that we are approaching this apex, my sense is that if it breaks and it breaks to the downside, I don't really want to risk as much on the trade. And I feel that as we are coming close to this apex, and we're coming close to the beginning of June when I think that this could occur, I really want to protect ourselves in terms of the risk part. And of course, if it does break to the upside, I still want to position ourselves to take advantage of that. So traders, we're looking at a daily chart. Again, this is standard candlestick format. We're not getting a ton of information out of the charts either way, whether it's Japanese candlesticks or Japanese average charts. What we are seeing in terms of information is different levels of support and resistance, but they're, again, highly defined in terms of this narrow trading range. Look at this last week in trading. It's just been almost a straight linear line trading within the most narrowly defined range I've seen. One. Secondly, we're getting this alternating color. And whether it's a straight candlestick or a Japanese average chart, color is so important when we look at the market, because we can define a market in a rally as having either a consistent consecutive greens going up regardless of the body size, and on the downside, meaning during the market selling off, we get a abundance of red candles. Now, so for example here, even though we have a couple of reds in between, meaning days in which it closed lower, predominantly you have green candles here, predominantly you have red candles. So we typically get this type of a market during an uptrend or a downtrend. Now, during a sideways market, of course, you get alternating candle color, and that's exactly what we're getting. You've got red, green, doji, red, green, doji, red. So you can see that predominantly it alternates back and forth between the colors. So what kind of information are we getting from the Japanese average charts? We're going to start by this weekly. And what we can see, and what happens in the Japanese average chart, of course, is you're filtering out a lot of the noise. And by filtering out that noise, it gives you a more easy to identify indication of trend and strength of trend. You can see that all green all the way up until you start getting this tail. This lower tail comes in, then the market moves down. However, as this market moves down, you get these 2 solid weeks of downtrend. We get our bottom in here. This is roughly just below 1280. And then you can see that aside from this one candle, which is still red but a tick away, you've gotten these candles getting smaller and smaller in size over the last month. They're definitely looking as though it's either sideways or pivotal. We know that it's sideways, but we are getting this compression. Once again, if you look at these lows, they're going higher. You look at the highs, they're going lower. And we are getting this compression. So it's pretty clear on a weekly chart that we could be coming to the end of this sideways activity. Of course, we're not seeing the same when we convert it to a daily. In fact, when we convert it to a daily, we're getting much the same information that we've gotten with our candlestick chart, and that is alternating candle color, very, very small body candles. Tells you the market's trading sideways. There's no clear-cut trend. There's absolutely no direction in the market whatsoever. It's moving sideways right now. The key to the fact that it's moving sideways is when you get that compression of range, you will typically see some sort of a breakout. And whether we'll see that or whether this is just the quiet before the quiet, as I've termed it, is something that will be determined at a later date. We'll see how it unfolds. But I can tell you this is unusual activity, very unusual activity in the precious metals markets. So traders, I pulled up our weekly chart. It isn't Japanese average, but it's irrelevant what type of chart we're using, because what we're really looking at is all of these different fib levels. They start from these different bottoms here. You can see by the 100%, they all move up to the top. And what we look for, of course, in a chart like this is harmonics. The reason I bring that to your attention is we really, on this entire chart, only get two sets of harmonics. We get a triple harmonics, which is quite unusual right here. And then we get a double harmonic right here. Other than that, you can see that there's a couple of points in which they're close, but they're not on top of each other to give us that true harmonics. And by harmonics, what I mean is where you have different time cycle price cycles that have a point in which one reads 50, one reads 61%, but they're reading the same area. And you get that here at 1292 and 1295 being the harmonics. Markets trading right in that area. It's been clustered in this area, as you can absolutely see. If you look at the end or the most recent activity, again, this is a weekly chart, and I have deemed this to be pretty critical in terms of an area that we need to be supportive, because the next supportive area that's very, very strong below this comes in just at below these lows. And so I think that we've got some very, very strong support right now, 1278 to 1285. And then in terms of various levels of support and resistance, we need to pull up another. So we've got our daily chart back up. Let's go ahead and convert that back to a standard candlestick chart here. Although it doesn't make that much difference, but I do want to see true opens and closes in the market. There we go. And so what we're looking at in terms of levels of support and resistance, let's look at resistance first. We absolutely have real resistance at about 1328, 1331 right in here. It's based upon this top. The next real level that we get is going to be this 1312 to 1314. It's these series of tops right in here. Those are the two critical levels of current resistance. We do have this 95. That's a 61%. So We'll name that the fact that the market's trading at 92, it's got to be resistance. Now, in terms of absolute support, we're showing support at 83. And of course, these lows down here, I believe, are aberrations in the market, meaning they're not true trading ranges. You don't see any bodies whatsoever, meaning the range between the open and close on a true candlestick. We don't see anything below 83. And so that's why I'm pegging the support at around 83 right now. You can see the market drift below, which is why I'm saying put your stop just below that. You want to account for these moves right in here, these potential moves. However, when we take a look at the marketplace itself, strong support, call it 80 to 83, and resistance, we've got something at around 1300, 1295, then 1314, and the top is 1329 to 1331. That's where I peg those levels at. Silver. Well, silver's just been a dogfight, and you know that unless it goes back above 1958, I really can't get bullish. But what we have seen over this last month, just as we're seeing it in gold, is a succession of higher lows here. However, we're not getting the lower highs. We're getting really a mishmash on the top of this market. It's in terms of the bodies, you've got almost a flat top, but in terms of the range, you can see that it's whipped all around the market. It's a thinner market, obviously, than gold, but the fact that we're starting to see these series of higher lows is drawing my attention to the market, so that if we did see gold break above that resistance line that we talked about in terms of the standing resistance line in gold, that would be a point, and the market was trading above 1958, that would be a point that I would actually consider issuing some sort of a buy signal in silver. Until then, we have raised our stops. We're long on gold. We're sidelined on silver. Have a great Memorial Day weekend for those in the United States. We will not have a show on Monday due to the holidays, 3-day holiday. Have a great holiday if you celebrate here in the United States. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you next week for another daily update and review. Bye-bye.